Welcome to our journey into the world of investment decision making. Whether you're a beginner or have some experience, understanding how to make smart investment choices is crucial for building wealth and securing your financial future. In this video, we'll break down the key steps, strategies, and mindset that successful investors use. We'll start by exploring what investment really means, why it matters, and how decision making plays a central role in achieving your goal. Let's set the stage for smarter investing together. Investment is the act of allocating resources, usually money, with the expectation of generating income or profit. It's more than just saving, it's about putting your money to work. Investments can take many forms, including stocks, bonds, real estate, or even starting your own business. The key is understanding that every investment carries some level of risk and potential reward. By grasping this basic concept, you're already on your way to making more informed decisions. Every investment decision you make can have a significant impact on your financial future. Good decisions can help your money grow, while poor choices might lead to losses. That's why understanding the decision-making process is so important. It's not just about picking the right stock or fund, it's about having a clear plan, setting goals, and being aware of your risk tolerance. Let's dive deeper into why your choices matter so much. Before making any investment, it's essential to set clear and realistic goals. Are you investing for retirement, a home, or your child's education? Defining your objectives helps guide your decisions and keeps you focused. Goals also determine your investment horizon, how long you plan to invest, and influence the types of assets you choose. With clear goals, you'll be better equipped to measure your progress and stay motivated. Risk is an unavoidable part of investing. Different investments carry different levels of risk, and it's important to understand what you're comfortable with. Stocks, for example, can offer high returns but also come with higher volatility. Bonds are generally safer but may yield lower returns. By assessing your risk tolerance, you can choose investments that match your comfort level and financial goals. There are many types of investments to choose from, each with its own characteristics. Stocks represent ownership in a company and can provide dividends and capital gains. Bonds are loans to governments or corporations, offering regular interest payments. Real estate can generate rental income and appreciate over time. Mutual funds and ETFs pull money from many investors to buy a diversified portfolio. Understanding these options helps you build a balanced investment strategy. Diversification means spreading your investments across different asset classes to reduce risk. By not putting all your eggs in one basket, you can protect yourself from significant losses if one investment performs poorly. A diversified portfolio might include a mix of stocks, bonds, real estate, and other assets. This approach helps smooth out returns over time and provides more stability. For investing, it's important to do your homework. Researching potential investments helps you understand their risks, rewards, and how they fit into your overall strategy. Look at company financials, industry trends, and economic indicators. Use reliable sources and don't rely solely on tips or rumors. The more informed you are, the better your decisions will be. Financial statements provide valuable insights into a company's health and performance. By analyzing balance sheets, income statements, and cash flow statements, you can assess profitability, debt levels, and growth potential. Learning to read these documents is a key skill for any investor. It helps you make more objective decisions and avoid emotional reactions to market swings. Market trends can influence investment decisions. By keeping an eye on economic cycles, industry developments, and global events, you can anticipate changes that might affect your portfolio. However, it's important not to chase trends blindly. Use trends as one piece of the puzzle combined with solid research and a clear strategy. Investing is a long-term game. Patience is key to weathering market ups and downs and allowing your investments to grow. Avoid making impulsive decisions based on short-term market movements. Instead, stick to your plan and give your investments time to mature. Over time, patience often pays off with better returns. Human psychology can influence investment decisions in surprising ways. Common biases include overconfidence, fear of missing out, and loss aversion. Recognizing these biases helps you make more rational choices. Stay aware of your emotions and try to base decisions on facts, not feelings. This self-awareness is a powerful tool for any investor. A well-constructed portfolio is the foundation of successful investing. Start by choosing a mix of assets that align with your goals and risk tolerance. Rebalance your portfolio regularly to maintain your desired allocation. This ongoing process helps you stay on track and adapt to changing market conditions. There are two main approaches to investing: active and passive. Active investors try to beat the market by picking individual stocks or timing trades. Passive investors, on the other hand, aim to match market returns by investing in index funds or ETFs. Each approach has its pros and cons, and the right choice depends on your goals, knowledge, and time commitment. Compounding is one of the most powerful forces in investing. It means earning returns not just on your original investment, but also on the returns that investment has already generated. Over time, compounding can turn small, regular contributions into significant wealth. The earlier you start, the more you benefit from this effect. Before investing, it's important to know how much you can afford to invest. Setting a budget ensures you don't overextend yourself or risk money you might need for emergencies. Track your income and expenses and decide how much you can comfortably invest each month. This discipline lays the groundwork for long-term success. An emergency fund is a safety net that protects you from unexpected expenses. Before making major investments, set aside enough cash to cover 3 to 6 months of living expenses. This fund gives you peace of mind and prevents you from having to sell investments at a loss if something goes wrong. There are different types of investment accounts, such as brokerage accounts, retirement accounts, and education savings accounts. Each has its own rules, tax advantages, and limitations. Choosing the right account can help you maximize returns and minimize taxes. Make sure you understand the options available to you. Investment fees and costs can eat into your returns over time. These include management fees, trading commissions, and fund expenses. It's important to understand what you're paying and look for low-cost options when possible. Even small differences in fees can add up significantly over the years. Taxes can have a big impact on your investment returns. Different investments and accounts are taxed in different ways. Understanding how taxes work helps you keep more of your gains. Consider strategies like tax-advantaged accounts, tax loss harvesting, and holding investments for the long term to minimize your tax bill. It's important to have realistic expectations about investment returns. Markets can be unpredictable and there will be ups and downs along the way. Avoid chasing high returns or expecting to get rich quick. Instead, focus on steady long-term growth and stick to your plan. Once you've made your investments, it's important to monitor their performance regularly. Review your portfolio at least a few times a year to ensure it's still aligned with your goals. Make adjustments as needed, but avoid overreacting to short-term market movements. Over time, some investments may grow faster than others, causing your portfolio to drift from your target allocation. Rebalancing means adjusting your holdings to bring them back in line with your original plan. This discipline helps manage risk and keeps your strategy on track. Every investor makes mistakes at some point. The key is to learn from them and avoid repeating the same errors. Analyze what went wrong, adjust your approach, and keep moving forward. Mistakes are valuable learning opportunities that can make you a better investor over time. Sometimes it makes sense to seek help from a financial advisor. Professionals can offer personalized guidance, help you develop a strategy, and keep you accountable. Make sure to choose an advisor who is qualified, trustworthy, and understands your goals. The investment world is always changing. Stay informed by reading financial news, following market updates, and continuing your education. The more you know, the better equipped you'll be to make smart decisions and adapt to new opportunities. There are several common mistakes that investors make, such as chasing hot stocks, ignoring fees, or failing to diversify. By being aware of these pitfalls, you can avoid them and stay focused on your long-term goals. Remember, discipline and patience are your best allies. Emotions like fear and greed can drive poor investment decisions. It's important to recognize when emotions are influencing your choices and take steps to stay objective. Develop a plan and stick to it, even when markets are volatile. Successful investors focus on the long term. Short-term market movements can be unpredictable, but over time, disciplined investing tends to pay off. Keep your eyes on your goals and avoid getting distracted by daily market noise. Regularly reviewing your investment performance helps you stay on track. Compare your results to your goals and benchmarks. If you're not meeting your objectives, analyze why and make adjustments as needed. Continuous improvement is key to long-term success. Markets and personal circumstances can change over time. Be flexible and willing to adjust your strategy as needed. Life events like marriage, children, or career changes may require you to revisit your goals and investment plan. Technology has made investing more accessible than ever. Online platforms, robo-advisors, and mobile apps can help you research, invest, and monitor your portfolio. Use these tools to your advantage, but make sure you understand how they work. Many investors now consider ethical or socially responsible investing. This means choosing investments that align with your values, such as environmental sustainability or social justice. Research companies and funds to ensure they meet your ethical standards. Investing globally can provide additional opportunities and diversification. International markets may offer growth that isn't available domestically. However, global investing also comes with unique risks such as currency fluctuations and political instability. Do your research before expanding your portfolio abroad. Volatility refers to how much investment prices fluctuate. High volatility can mean bigger gains or losses in the short term. Understanding volatility helps you manage your emotions and stick to your plan even when markets are turbulent. Inflation reduces the purchasing power of your money over time. When making investment decisions, consider how inflation might affect your returns. Choose investments that have the potential to outpace inflation and protect your wealth. Liquidity refers to how easily you can convert an investment into cash. Some assets like stocks are highly liquid, while others like real estate may take longer to sell. Consider your need for liquidity when making investment decisions, especially if you might need access to your money quickly. Leverage means using borrowed money to increase your investment potential. While leverage can amplify gains, it also increases risk. Make sure you fully understand the risks before using leverage in your investment strategy. Discipline is essential for successful investing. Stick to your plan, avoid emotional decisions, and stay focused on your long-term goals. Consistency and discipline can help you navigate market ups and downs and achieve better results. Your investment plan isn't set in stone. Review it regularly to make sure it still fits your goals and circumstances. Life changes, market conditions, and new opportunities may require you to update your plan. Stay proactive and keep your strategy current. Continuous learning is a key part of successful investing. Read books, take courses, and seek out reliable information. The more you know, the more confident and capable you'll be in making smart investment decisions. Investing for retirement is one of the most common goals. Start early, contribute regularly, and choose investments that match your time horizon and risk tolerance. Planning ahead ensures you'll have the resources you need when you stop working. Besides retirement, you might invest for other goals like buying a home, funding education, or starting a business. Each goal may require a different strategy and time frame. Define your goals clearly and choose investments that fit each one. Take time to celebrate your investment milestones, no matter how small. Recognizing your progress keeps you motivated and reinforces good habits. Every step forward brings you closer to your financial goals. Congratulations on taking the time to learn about investment decision-making. Remember, successful investing is a journey that requires knowledge, discipline, and patience. Review your goals, keep learning, and stay committed to your plan. With the right mindset and strategies, you're well on your way to building a secure financial future.